Good evening, everyone. Good evening. Welcome to Money Mindset, Financial Literacy online seminar. Tonight is our first night. I'm starting to see some YouTubers come on. Welcome, YouTubers. Please share your YouTube link. You don't want to miss tonight. We have two very special guests on tonight that are going to be presenting. So make sure you share this live. We will be bringing on our guests soon. Hold on. Hope everyone is having a good evening. Hope you're ready. I hope you brought your questions. I hope you have your notepad, your pen, so we can take some notes on tonight. Welcome. I'm seeing some Facebook viewers come on. Welcome, Facebook. Please share this live. We will be getting started shortly. Hello, husband. My hubby's on. Please make sure if you have any questions tonight to put them in the chat so our presenters will be able to answer your questions on tonight. This is our first session, so we're going to have a very good overview about our session and what's upcoming on the following sessions. Okay, looks like we have some more YouTubers on. Welcome. Okay, we're almost there, I see some more Facebook viewers on. Welcome, Facebook. Please share. Okay, we're going to get started. So welcome everyone to Money Mindset. My name is Shirley Herring. I bring you greetings from Darius Hope Outreach Ministries. This is a part of our Linking Professionals platform. And we have two wonderful presenters on tonight where we are going to be bringing them on. And first we have the one and only Afia Jean-Pierre. Did I say it right?
Said it perfectly, Shirley. Perfect.
And we also have none other than Mr. Ed Sanchez. And they are both from Manhattan, New York. I welcome you to Money Mindset on tonight. And what we are going to do first is we're going to have Afia to tell us a little about herself. And then I'm going to have Afia introduce Mr. Ed Sanchez. So it's on you, my dear.
Okay. First off, Shirley, thank you so much for having us on this platform. There is Hope Outreach Ministry. We so appreciate you sharing this with us. I want to say hello and greetings to family, friends, associates, everyone who has come aboard to share this experience with us. Thank you so much for coming aboard. Let me introduce myself. My name is Afia Brown Jean-Pierre. Yes. And me and my husband, Aaron, we've been in the financial world for a minute now. And learning and growing and learning. Yes. So we're partners in this business and we enjoy so much. So, Shirley, if I could share my story briefly.
Yes, you can.
Oh, great. Thank you. Thank you.
Sure.
So, so a girlfriend of mine, a good girlfriend of mine, named Kavina Coxum, she was released from her job of unceremoniously she worked there like 30 years, and they released her. And of course, it was a sad and abrupt and shocking thing to have happen. And I'm quite sure that some of you may even know of someone who has experienced such a tragic situation. So, mind you, weeks went by, and I noticed she wasn't trying to get her resume together. I noticed she wasn't looking on Monster or any of these other, engines for a job. I noticed she wasn't trying to borrow $5 from me, which I appreciated that. But I had to say to her, Kavita, what's going on? And she's like, what? And I'm like, what do you mean, what? I mean, what's going on? And she's like, well, I'm okay. And how are you okay? Well, once upon a time, I started paying myself first. So I started putting away every month a little something. I paid myself first. I forgot about it. And so years later, after this has happened to me, I looked at my account and I'm okay. So woe is me. A little light bulb popped into my head, and I said to myself, you know what? You need to be in this kind of business that help people, that service people, to help them put things in place. So when these things happen to them, and even if it's not these kind of things, if a situation comes up that they want to buy a house or want to do anything, vacation, anything, you want to help people to put these type of things into place. So fast forward, I became a life insurance agent. Yeah. And then I am newly a fully and proudly a fully licensed securities agent. Can we get a whoop whoop? Thank you. So that is my.
We're having some technical difficulties. Bear with us. Afia, are you?
I'm here.
Okay, all right. Okay.
Yeah.
I didn't hear the last thing because I thought you went out for a minute, but
yeah, no, but that's basically how I came into the business when I realized the services that could help people live a better life and make better choices and decisions. So financially, because that's what we're here for, right? To learn more. That's right. So I'm here.
I love that story.
Thank you.
So tell us about Mr. Ed Sanchez.
Well, first off, everyone, let me introduce to you Ed Sanchez, right? As mentioned on the flyer, and as he will tell you himself, he has had many pitfalls in this money game, like unimaginable things has happened, and he has come through it. And so, thankfully, of experience. Everybody's back?
Yes.
Everybody's back? Okay, awesome. So thankfully, the pitfalls that he has gone through, right? We have his wealth and knowledge. We have his experience. Yes. And so I like you had said earlier, Shirley, get out your pads, get out your pens, and be prepared. I love it. Be prepared, to learn, to write, to have your questions ready, to put your questions in the chat as well. And once again, it is my pleasure, it is my honor to present to you Ed Sanchez. Take it away, Ed.
Thanks, Sophia. Thanks, Shirley. Just checking. Give me a thumbs up if you can hear me or okay. All right. I'm not going to take as much time as Sophia did with a story, other than I'm 68 years old, 3 kids, 6 grandkids. So I've been around the block a few times. Grew up in East Harlem, and I'm a PK. I'm a preacher's kid. So obviously that didn't help me with my finances. My father could help me on a lot of things, but he didn't know what to do with his money, just like I didn't know what to do with my money. Okay. So I'm just gonna, we all know the situation that's happening in this country now, and there's a lot of people struggling, and a lot of people struggle because they just don't have the knowledge. Okay. I've been in the financial services, ready for this, 50 years. I started working on Wall Street on 1974. The first 25 years was in the back office, basically just pushing paper, doing accounting work, moving millions of dollars every day, but no idea what I was doing with my own money. I have clients now that are accountants that work at banks, and they still don't know how to handle their own money. That's just something that's not taught in schools anymore. Okay, we get a lot of math classes in classes, but we don't get any personal finance classes. So I basically, worked just like everybody else for 25 years in the back office. Was able to purchase my first home and move out. And if you're like me, I was just so surprised and happy that they approved my mortgage, that when I went to closing, every paper that they put in front of me, I just signed. I just signed everything, because there was a pile of papers, there was the keys to the house, and I'm saying, if I sign these, I get the key. So I had no idea what I was signing. I had no idea what kind of mortgage. I was just happy that I got approved. All I knew was what my monthly payment was, that I had to come up every month. And that's kind of my financial journey. Years after that, I said, you know what? I got a family. I got to get some life insurance. I bought the wrong kind of life insurance. Wasn't really investing because I had a good employee stock ownership plan at work. Okay. After 25 years, my company went bankrupt. So when the company went bankrupt, on the same day, not only did I lose my job, I lost my retirement plan, because all my retirement money was not separately invested. It was invested in the same company. When my company filed for bankruptcy, we were taken over by a company called Prudential. And what I noticed was that all the people like me that were in the back office, we needed to interview for a job at the new company. But at One New York Plaza, where my office was, there was about 30 limousines, and all those limousines were taking the stockbrokers to Tavern on the Green in Central Park, offering them jobs to stay. Okay, so I quickly found out that I was on the wrong side of the business. Okay, I wasn't on the income generating, I was on the supporting. And that's when I decided, hey, you know what? I'm going to start getting my licenses just like they got their licenses. So I got my insurance license. I got my investment license. I got all these licenses that I didn't know. I got my Series 6. I got my 63. I got my 26. I got my 65. Now, at the ripe age of 68, I'm studying for my mortgage license, because these are the licenses that I need to service my community. Okay. So I'm licensed in all these areas. Okay. Handling millions of dollars of people's money, but my average account is 25,000. Okay. So I'm not a big hedge fund guy. I'm just helping ordinary people, okay, get a handle on things. So I, and Shirley, I respect your platform, and I won't be too, but I'm going to just do a recap, and then we'll let you chat, and then we can go into some specifics. So I'm just going to hit a couple of different things, okay, tonight, to get things right. Okay. So would you agree, right, that we need to get our financial house in order, right? Most of us, our financial house is not in order. Okay. So we need to fix it. Okay. So in some of us, we need to rebuild, right? So using that in mind, just picture in your mind, right? A house, right? And the most important thing, right, is the foundation, right? So the foundation of the house. But before I get into that, let's just go into let's go into the first slide, Shirley, which is the take control slide. All right. Let's just go over the things we can't control and over the things that we can control, right? So we can't control the future of Social Security, right? Every election, they tell us about how young folks, might not get Social Security or will have to wait later, right? We all know we can't control our employer, right? I can tell you, I can attest to that, right? COVID proved that to a lot of people, okay? We can't control what the taxes are going to be. We can't control inflation. Wow, that's so prevalent now. On stuff just costs like double what we used to pay a couple of years ago, right? So we can't control rising costs, okay? And we can't control the risk of a single investment, right? I can attest to that. All my money was in my company stock, right? You could have all your money in one company, and if that company goes south, so does all your money, just like it happened to me, okay? So these are the things that you can control. You can control saving for retirement. You can't control other sources of income. A lot of, right? Side hustle used to be like a bad word. Now it's a good word. Everybody's looking for a side hustle, okay? Because most people need to make extra income, okay? Ways to reduce your taxes. There are ways that you can reduce your taxes, okay? Maximize your savings. We'll go into that. You can control saving more. And you can control diversifying your investment choices. It's amazing how many people I sit down with and they tell me they got a good plan at work. I says, great, awesome. What was the rate of return that your plan paid you last year? And you know what most of them say? I don't know. And you cannot afford to not know. Just imagine this. Imagine they passed a new law that your child gets a report card when they graduate from high school. We're not going to give any report cards out till they're age 18, right? Is that insane, right? You want to know at least a few times a year how your child is doing, right? You adults out there, when is the last time you got a report card? When is the last time somebody sat down with you and say, how you doing? How's your credit situation? How's your debt? How's your 401k looking, right? So what happens? Right? So all of a sudden you hit your 60s, you start thinking about retirement. You're shocked at how little you are going to get from Social Security. If you're in the mid 60s like me, you have to relearn the alphabets. You got to learn about Medicare A, Medicare B, Medicare C. So all these things seem to happen, right? So I know that on this platform, there's people in their 20s and there's probably people in their 60s like myself, but we're going to help everybody here, okay, get financially literate to make some choices, right? Because everybody is in a different place, but everybody can improve their situation. So let's talk a little bit about maybe some of the things that we can control. So if you look at the financial house, right? The Bible tells us that we should plant our houses in the sand, right? Is that what the Bible says? No, I remember that Sunday school class, right? You got to build it on a rock. You got to build it on something solid, right? So what's the foundation? So let's just look at slide number 2, which is the importance of life insurance. And I'm not going to get into a big discussion, but there's some of you young folks out there. Okay, so if I ask most people, what's your most valuable assets? Some of them tell me my house, right? Some of them tell me my 401k, right? Some of them tell me, you know, my future lottery winnings, right? So let's look at this for a second. How much is your car worth? And how much is your house worth, right? So we insure our cars, right? We insure our homes. We insure our cell phones, right? Almost every major appliance, when you go to the register, they ask you, would you like to pay insurance on it? And a lot of us do, okay? But, you know, I heard a nice example the other day. If you had a house, right? And you had a car and you had a tree in front of your house, in what order would you insure that? And most people would say, well, I would insure the house, and I would insure the car, and then I would insure that tree in front of the house. Okay. And then the question was asked, if that tree, the leaves, twice a month, those leaves turned into $100 bills, would you insure that tree? Then they said, of course, I would insure that first, because that's producing money every 2 weeks. Well, guess who the tree is? The tree is you and me. The tree is you and your spouse, right? And in most cases, somebody relies on that paycheck. Some of you might be older and nobody relies on your income. It doesn't necessarily apply to you. But if somebody's relying on your income, let's say you have, you know, a husband and wife working, both bringing in a few thousand a month, God forbid something happens to one of them, okay, that income stops. But I promise you, the mortgage payments won't stop. The electric bill won't stop. The cable bill don't stop. Okay, so we got to talk about that. Does that make sense? Okay, so that's the foundation. You got to get that straight. As you're building a little higher on the house, how's your debt situation doing? Let's go to the third slide. How many of you, it seems like every time you go to a department store and buy something, they tell you, would you like to save 10% on this purchase, right? And you know what I always ask the cashier? What's the interest rate on the credit card that you're offering me? And guess what the answer is? They don't know, because their job is just to offer you the credit card. Okay? Now, I know there's probably nobody that's listening to me right now that's in credit card debt, right? Remember the first time you went to college, right? And Visa was there and MasterCard was there. And you needed like a backpack or something. They gave you that free backpack, or maybe you got that free Costco shopping bag. Okay, let's just look at 3,000, right? See, right now they're saying the average credit card the average family is about $18,000 in credit card debt. So that's average. So some of you are saying, how could somebody have $18,000 in credit card debt? And some of you are saying, I wish I had only 18,000, because it's an average. So some of you have less, some of you have more. But right, you probably know this. Actually, I don't know if you recently have looked at your credit card statements, but they actually a few years ago made them put on the statement what it's costing you and how much money you can save if you made extra payments. But right now you take it, right? So you got pre-approved for a credit card, right? And they pre-approved you for $3,000. And you said, thank you, Jesus. I got $3,000, right? But I'm only going to use this for an emergency, right? And all of a sudden, somebody in your family say, oh, man, you know what? I'm doing a destination wedding to Punta Cana. I wish you could come. And you say, oh, man, I can't come. But then I says, man, but I got this credit card and the trip is only $2,500, right? So you put it on the credit card. you know, and then while you were out there, you spent another $500, right? So look at what happens if you just make the minimum payments. That $3,000, you end up paying $5,000, right? You ever notice how when you send $50 to the credit card company, your bill doesn't go down by $30? If you send 50, it will go down by $10, right? Because a lot of it, you know, the higher the credit card balance, the more is going towards interest. So we need to get a handle on that, and we'll talk about that, something specifically that you can do. Okay. I know a lot of people, they take the credit card balance, they move it to another account because it's 0 for 6 months, and then the 6 months come and it goes back up to 29. So the best way to pay off debt is paying the debt off, right? Those of you who know the Bible a little bit more than me, it says something about the what is the debtor to the debtee, right? The Bible calls you a slave, right? So we need to get out of debt. All right. So now that we're talking about interest, let's go to the rule of 72. Some of you might know this. I'm going to do this very quickly, okay? Because I promised Shirley I wouldn't be on too long, okay? But right, you're either getting interest, right, or paying interest, right? Now, if you're getting interest, you would want to get as high as interest as possible, right? And if you're borrowing money, you would try to borrow it at the lowest at the lowest rate. Does that make sense? But that's what's happening in the real world. So if you have a bank account at Citibank, they're probably paying you about 1.5%, unless it's locked into a CD, right? But how much is that credit card? So they're paying you 1.5% on your money. You're paying them 19% on when you use the credit card. You know, that's why the bank lobby looks a lot better than our homes, because I mean, look at the impact. So let's look at this example here. Okay, it's called the rule of 72. You can Google it. Basically, this is a format that if you take an interest rate and you divide it into the number 72, the answer to that is, how long does it take approximately for your money to double? Okay, so we're going to use 3, 6, and 12 because I don't like using decimal points. So we'll use stuff that goes in evenly, right? So 3 into 72 goes, right, 24 times. So that means your money would double every 24 years. Okay. So if you started at 0, so let's just say somebody had a baby, right? And you put $10,000 in their account. Okay. I remember when J-Lo had the twins and they gave them, I think, $3 million to do the photo shoot. So you could just, you know how Jay-Z and J-Lo, you know how this is just $10,000, okay? So at 3%, right, it doubles, right? So that when that child is 24, they got 20,000. When that child becomes 48 years old, they got 40,000. You see how that works? Now, if you double the interest rate, right, you would think that the bottom would double, but it doesn't, because you have compound interest, right? So now if you do 6 into 72, right, that means if your money averages 6%, your money doubles every 12 years. By the way, I don't want to depress you, but 3 goes into 72 24 times. So if you're getting a 3% raise, it's going to take you 24 years for your salary to double. Don't get mad at me. I'm sorry. Let's go to okay. So hopefully you got a 6% raise. If you got it, so if your money's growing at 6%, right now it's every 12 years. Now at 12 years old, that kid got 20,000. At 24 years old, that kid has 40,000, right? 36 years old, 80,000. 48 years old, 160,000, right? Let's take it up a notch. Let's go to 12%. Do you think wealthy people get 12% on their money? 10,000. Now your money doubles every 6 years. So now at age 6 is 20,000, 12 is 40,000, 24 years old, it's 160,000, right? That's why these wealthy kids, they don't take student loans, right? But if they don't, right? So at 48 years old, they got what? $2.5 million. Now at $2.5 million, right? If you wait another 6 years, right? Which would be what? 54, that doubles to $5 million. Okay. Now, imagine if you just did $1,000 every time a child was born in your family. If y'all did a GoFundMe and put $1,000, okay, just take a zero off, right? It would be 256,000 instead of 2.56. Okay, so so we'll go into that. All right, so this is right. So you see these big numbers on the 12% side. That's what the bank's getting on your credit cards. They right. Would you agree that most credit cards are probably close to double that now? Okay, so we have to start learning how to go from 3% to 6% to 12%. And we'll go into some specifics, okay? Because this is not a solicitation for anybody, but you need to know how interest works, because whether you like it or not, you're getting interest or you're paying interest. Okay, so let's go to the next slide, which is because after you have your foundation, right? And after you have, right, because most people don't save money because they're in debt. So after you have your foundation, you gotta handle the debt problem. You got to get rid of that debt. Okay, moving it. Do you do debt consolidation? No, we do debt paying. Let's pay it. Consolidate it. It might work short term, but the goal is to get rid of it. Does that make sense? Okay, so let's go to the next slide, which is the 3 accounts you know.
Okay. One question, Ed. Do you want a question pertaining to the 72 rule now or at the end?
No, I'm gonna probably end in about 5 minutes, and then we can do the questions.
Okay. All right.
Okay. Okay. Now, just like a house is not built overnight, neither is your finances. But this has to be the goal. Everybody should have 3 accounts. Account number 1 is an emergency, right? COVID showed us that we needed an emergency, right? Because a lot of people weren't working. That stimulus wasn't enough. Okay, so what is an emergency, right? Car breaks down, hot water heater breaks down. Okay, that's something that you need to have a goal. I always recommend that people find out what your monthly bills are, multiply that by 3, and that should be in your emergency account. And it should be liquid. It should be in a bank. It doesn't matter. You don't need your emergency account to be growing at any height. You just need it there in case something happens, because it will happen. And if you don't have an emergency comes and you have an emergency, then you go to the pretty little cards, right? And then so when you hit the debt, right? Ladies, you need to do the plastic surgery. You know what that is, right? Cut up them cards. Cut the plastic. Okay? So, second, you need to have a short-term account. You might be saving up for a house. You might be saving up for a major purchase. Okay? So, that's number 2. Okay? Number 3 is your wealth building. That's where your retirement. Okay. Now it doesn't matter what age. I still have the 3 buckets, but at age 68, my 3 buckets are different than my kids' buckets. You follow? Because I have my emergency, right? I have my short term. Okay. Now, my wealth builder is not for my retirement. My wealth builder is for when I'm gone, that somebody will benefit from that, right? Because I don't, the reality is that I've lived more years than I'm going to live. Yeah, but if you're 30 years old, these three buckets are different. You need the emergency, you need the short term, which is maybe for a deposit for a house, and then your wealth builder is your retirement. But if you're in your 60s, it's a little different. Does that make sense? Okay, so let's go to the next one, which is comparing tax treatment. And this is my second to last slide, and then we'll do like a little recap, and then okay. We're in tax seasons, and you hear the term traditional IRAs, Roth IRAs. Most of you know this, but for the benefit of those who might not, okay. And if you're above age 50, they allow you, because they know most of us are behind in saving, so they allow us. But basically, a traditional IRA, okay, is very similar to like the 401k you have, okay? In a traditional IRA, a lot of you, let's just look at the 401ks for a second, right? If you're putting money into a 401k, let's say you make $1,000 a week and you're putting $100 into the 401k, you're not paying, you made 1,000, but you're only paying taxes on the 900, because that money is going into that money is going into your 401k pre-taxes, right? So you're not allowed to touch that money till past age 59 and a half. If you touch the money prior to that, you're going to take a 10% penalty. Was listening to the news this morning. There's a record number of people borrowing from their 401ks. Okay, don't do it unless it's an absolute. Don't do it. If you borrow money from your 401k and you lose your job, then that loan becomes a early withdrawal, and then you're going to pay taxes. So stop borrowing from your 401k unless it's an absolute emergency. But that's I don't recommend that. Okay, so a traditional IRA, like for people who don't have a plan at that job, okay. So let's say if you make $60,000 a year and you put $5,000, okay, into a traditional IRA, so that reduces your taxable income from $60,000 a year. So now you're only going to pay taxes on the $55,000, because with a traditional IRA, you're allowed to take that as a deduction. Okay. But remember, you can't touch it till age 59 and a half. Okay. And remember, with the traditional IRA and with the 401k, remember, you didn't pay taxes. So when you retire and you start withdrawing the money, you're going to pay taxes on that at whatever tax rate you are when you're retired, but you only pay the taxes as you use it. So it's not like if you retire with $500,000, you're only going to pay taxes on what you withdraw. Okay. So you didn't pay taxes going in, but Uncle Sam is waiting for you later when you retire. Okay. Now, with the Roth is a little different. A lot of people are using the Roth more, because with the Roth, you're putting after tax. So let's just say you make $60,000, you put $5,000 in a Roth IRA, you don't get the deduction. Okay. But the money grows tax deferred, just like the traditional IRA. But down the road, when you withdraw money, it's not taxable, because you already were taxed on that money. So one, you don't pay tax at the beginning, you pay tax coming out. The other one, now there's a couple of exceptions that we can get into, but in general, that's how they work. Okay. So I just wanted to make, okay. So the last slide I'm going to go over is the mutual fund. Okay. Now, this is not a solicitation for you to buy mutual funds. If it was a solicitation, I would have to provide you with a prospectus on the particular mutual fund that I was talking to you about. So this is just general, okay? We all heard the term, don't put your eggs in one basket, okay? Most of you probably are in a mutual fund. If you have a 401k, chances are you're in a mutual fund. If you have a pension, chances are your pension manager is probably investing in a mutual fund, okay? And basically what it does, it allows an individual, okay, to co-opt their money with other investors under a professional manager, whether it's Vanguard or Franklin or whatever, okay? And then they invest that money, okay, collectively. Okay, so just picture this. You go to the mall, right? You can buy stocks in Macy's, or you can buy stock in the mall. So if you buy stock in the mall, you own shares of the combination of all the stores. Okay, so now there's different types of mutual funds. So you can, you know, if you like technology a lot and you want a fund that invest in technology companies, you know, I have a doctor that he likes to invest in pharmaceuticals. So you can decide, you know, what kind of companies. Then you have some people that just play it safe and they do what the averages are. I'll explain that in a minute. Okay. But it allows people. Okay. So so there's 3 or 4 companies that I deal with that lets people start with as little as $25 a month. Okay. So you don't need a lot of money. Okay. If you do $25 a month, and then a year later you increase it to $50 a month, and if you increase it and you let that compound. So one day we'll talk a little bit more specifically about this, and we'll talk into dollar cost average and specific, but I'm just trying to hit a few things, okay, and be respectful of the time. Okay. So just quick things that you hear on the news. Okay. Everybody hears S&P, right? S&P is Standard & Poor's, and is basically 500 of the top companies in the US. So when you see the S&P is up or down, it's an index of 500 companies, okay? You hear Dow Jones, those are the top 30, okay? So most people follow the S&P because it's a broader barometer of how the economy is doing, okay? Then you hear NASDAQ. NASDAQ, same thing, is a couple thousand companies, but NASDAQ focuses more on technology companies. So most of your tech companies are part of NASDAQ. So whenever you see NASDAQ taking off, okay, you know that those are the Apples and the you know, the technology companies. Okay, when the S&P, most people like following the S&P because that's like the widest range, and that kind of, a lot of times when you invest in some of these index funds, they invest in the S&P. So that's just a little bit. So when you see stuff in the news, you kind of know what's going on. But I strongly suggest that if you have a 401k, that you review that 401k. You know, and I know most 401ks, you're dealing with an 800 number. They're not or they'll tell you go on the website. Later on, Shirley will put my contact. If you just need somebody to review it for you, there's no fear or anything. But if I can help somebody explain it to you, so at least you know. I know when I sit down with clients, probably 7 out of 10 times, I usually recommend the change because, you know, usually people make their decisions by the guy next door. Hey, which one did you pick? Oh, I picked this one. Okay, that sounds good. Or my cousin told me that this one's good. Or I saw on the internet that you should do this. And so, you know, listen, this is money that you're going to be putting in every month for a long period of time. Make sure you get some good advice as far as that you're making the right choices. That makes sense? So I'm gonna wrap up there. I know that was it was kind of fast, but I just wanted to let you know that as we help you, we're gonna help you in different things, and we'll dive into, like, we'll probably do one just on life insurance and one just on investing, you know. But I just wanted to share this with you, And you guys can follow up with Shirley and say, listen, we want to hear more about this, more about that. Now, if there's stuff on the chat, I don't see it. But if there's something that's on the chat, I could probably hang on and answer some questions for Shirley, being respectful of your time.
Ed Sanchez, you are awesome. You are really awesome, Ed. I mean, you covered.
Listen, let me just say this. I am a great financial planner because I've made every financial mistake. Grew up in the projects, didn't know nothing about nothing. I know what it is to have a U.S. Marshal sticker on your door that you're getting evicted. I know what it is to get a foreclosure because you're 4 months behind on your mortgage. I know what it is to have somebody sell me a life insurance policy, which was no good. And the guy was my best friend. So every financial mistake that you can think of. So don't think I'm, but I can tell you right now that I am debt free and I'm financially independent. And you know what financially independent means? That I could stop working and I have enough income to pay my bills. Now I'm not financially free. That's another level. Okay.
Right.
Because listen, and I'll end with this. Listen, retirement is not a age, it's a number. I have clients that are 50 and they're retired, and I have clients that are 70 and they're still working, right?
Yeah.
Just go to Walmart. It breaks my heart to see 70, 75-year-old people. Do you think they're there because they want to? No, it's because they didn't know the rules of the money game. And hey, listen, my parents retired on 2 Social Security checks. So they okay. So I don't want you to feel, listen, so there's nothing that any of my clients can tell me that I probably haven't gone through myself.
Wow. Awesome.
Awesome.
Well, we do have some questions coming in. We're going to start at the top. I'm going to ask Sophia to read the first one. Where'd it go? Oh, okay. This is the one.
Okay, so this question is from Earl James. And he asked, can I use the 72 rule for my personal investments, or does it have to be only at my job? That's his question.
Well, that's a good question. No, it's for every, if you have a 401k, you are a participant, and you could apply those rules. You got to say, okay, you gotta that information, because what they do is they tell you what funds are available in your 401k, right? And then you start looking at those, and you could look at historical performance, and you're going to see stuff there that they're offering you that have averaged 3%. You're going to have stuff that's averaged 6%, and you're going to see stuff that's averaged 12 or more. And you got to make a decision, because there's risk tolerance involved. But yeah, now when it comes to an individual, it's called an IRA. You know what the I stands for? Individual. Right? So if you have a plan at work, you're a participant. If you have your own plan, guess what? You're an owner. Now you don't have to invest with the company that your company chose. You can pick your own company to invest. You have more to say because now the money is in your control. A 401k is good. Yeah, but everybody who has a 401k should start doing something on their own also.
Okay. Hope that answered your question.
All right.
Okay.
This one is from Kavina Copesome. If you do a mutual fund for, let's say, $25, is there different options to pay monthly, quarterly, annually? That's the question.
It depends on companies. I have clients that there's funds that will allow you to do something monthly, and then if you have extra money, you can add it, and it doesn't interrupt your monthly contribution. So if you get a good tax return or something, or a bonus, and you wanted to add it, as long as you stay under the minimum based on your age. So let's just say somebody's doing $100 a month, they get a bonus, and they wanted to drop in another $1,000. They can do that without interrupting their monthly. Let's just say, for example, during COVID, I had a couple of people that say, listen, I'm out of work. I need to stop my monthly draft. They stopped the monthly draft. And then when they were able to go back to work, they continued it. So you do have some flexibility.
Very good.
Okay, hope that answered your question. Okay, Afia.
Sure. Mr. Marcus 520. I have a high debt to income ratio. Is there a particular amount you need to have in order to start investing? In the question.
No, but I'm just saying, if I'm sitting down with somebody and they have a lot of let's say credit card debt, then we got to attack, it's good to invest, but we got to attack the debt, because if you're making 9% on your mutual fund, but you're paying 18% on your credit card, you saw the rule of 72, you're on the wrong side. So paying off a 22% credit card is the same thing as earning 22%, because that's 22% that you're no longer paying. So each situation is different, but if you have credit card debt, there's got to be a plan. If some people can do both, but if it's very high, you got to attack that high interest debt.
Okay, hope that answered your question.
Okay. So, Earl James, you said I should not borrow from my 401k. How about my life insurance?
There's some life insurance that have loan provisions. I don't particularly like those, because when you borrow money from a 401k, the interest that you pay back, you're paying it back to yourself in the 401k. If you borrow money from your life insurance, that interest that you're paying doesn't go back to you. It goes to the insurance company. And if you were to pass away, whatever the face amount you had, so if you had $100,000 policy and you borrowed $20,000 and you passed away, your family gets $80,000. I strongly recommend that you don't mix insurance with investment. I think they should be kept separately. You look at companies, you have group health insurance, group life insurance, and you have a 401k. You don't see any bundling of investments and insurance by companies. We shouldn't do it as individuals. Now, there's some high-end clients that it might benefit, but that chances are they're not on our chat.
Okay. All right. And our next one.
Okay, this is from Kervin Heron Sr.
My hubby.
Where do
I see the value of the American dollar?
In this time frame?
It's weaker than before, but I mean, if you're gonna compare it to the other currencies, it's still the most valued. Okay, as bad as we're doing, most of the other major countries are not doing as well either. Our inflation is starting to go down. Their inflation is still up. You see a big movement into crypto now. That's still that's a roller coaster that I choose not to be on. But in the framework, in comparing to the rest of the world, as a matter of fact, they were just talking about it today. Listen, we got a lot of problems in this country. You think you got a bad credit card problem? We're paying billions of dollars just in interest. They don't. So the problem is that I don't have a machine that I can print money at home. The government does. Imagine if you had a machine, every time you needed money, you can just go print it. And they just continue to print money. And sooner or later, they got to pay the piper. So hopefully they can become fiscally responsible, just like we have to, right? When we don't have the money, we got to tell the kids, hey, there's no money. The government says, because all this stuff that you see happening now, money to Ukraine, money where, money, that's on a credit card. So Help us, Jesus.
Yes.
Yes.
But if you compare us to the rest of the country, I mean, some of you might have traveled more than myself, but it's still the best economy.
Yes.
Very
Okay.
good.
Earl Jones says, thanks, Ed.
Okay.
Okay. Another question from
Okay. Is real estate still the most appreciative investment versus other items of asset?
I won't. I think most. I think obviously the only thing with real estate is you know, when it comes to investments is like generic. When it comes to real estate, it's geographical. Okay, you know, Florida real estate is going through the roof because a lot of people are going to Florida. You know, Texas real estate is, you know, so a lot of it is geographical, but it's still, I mean, it's still a viable asset. You know, there's years where the real estate market outproduces the market, and there's years where the market outproduces real estate. But I think historically the stock market outperforms, but it varies. If it does, it not by a lot, but a lot of it is geographical. A lot of it is geographical. You know, if you know, if you know, you could buy, if I buy a house in Arkansas, it's probably going to be cheaper than Old Bridge. So, but the general answer to that is that real estate is a good investment. But if you're a young family looking at doing it, 15-year mortgage. If you're in a mortgage now, ask your bank, do they accept biweekly payments? Right? We traditionally pay our mortgages once a month, right? So that means we make 12 payments. But if you do it bi-weekly, okay, that means you're making 26 half payments, right? 26 half payments equal to 13 monthly payments. Most of us get paid every 2 weeks. Okay, so if your mortgage company will allow you to pay your mortgage every 2 weeks, not extra. So if it's $2,500, you pay half of it every 2 weeks. That you could calculate it. It'll probably knock off 5 or 6 years off your mortgage.
That's true. Yes, indeed.
So just think about that. If you're sending $2,000 a month on your mortgage company and you don't do that for six years, how much is that? Imagine those last 6 years, that $2,000 is going into your retirement plan instead of to the mortgage company.
Right.
And if you could afford a 15-year mortgage, if you could stretch it, right? Because then you don't have to worry about the bi-weekly and all that stuff. It's going to save you a ton of money.
That's good, Ed. That's good. Okay, let's. Okay,
and
that's
the bank's not going to do it unless they ask me.
Nice. So we have Nikki Holloway.
That's my beautiful.
Okay, awesome. He just taught me something about 401k and insurance. All right, that's what we want.
So you know what? You could thank Shirley for that, for having us on. You know, it's funny. I had a text from a young man that his investments have done really good, and he thanked me. I said, no, thank your mom, because your mom opened that account for you, 15 years ago.
Okay, and this is from Regina.
Okay, we have Regina here. Awesome. Great job, Ed and Afia, on getting this information out to the public. Woo woo! All right.
All right. I like that, Afia. Yes. Okay, let's see. Another question. Ooh, my husband, he's busy.
All right, awesome. What advice would you give to a young enlisted service member?
Well, first of all, I want to thank you for your service.
Yes.
Okay, my son's a veteran also, so I salute you. Okay, but it really would depend whether the young enlisted serviceman, whether you're single, whether you're married, whether you have young kids, it would advise you. But here's my advice to young families, okay? Learn how to live on 80% of your money.
Mm.
The first 10 goes to who?
Pay yourself.
The first 10 goes to the
Oh,
Lord,
no, Ty. That's right.
right? Whether it's a church or whatever, right?
Right.
The second goes to you and your family.
Yes.
And then learn how to live on 80%. If you can learn how to live on 80% of your money as a young person, you'll be okay. And get good advice on how to do that 10%.
That's good.
Yes.
Okay.
I still kept while I was in credit card debt, I never stopped tithing.
That's important.
That's right.
And the rate of return on that, it's off the charts. Forget about the rule of 72.
Yes. Yes, you're preaching now. Okay, let's say bi-weekly payments, good advice.
Yes.
Now, some banks might do it. Some banks no. Some banks might charge you like a service fee to do it, but the service fee is it's well worth it. They might charge you like $15 per transaction, but it's worth it.
Okay. Let's see. All right, who's this? Yes, biblical principle.
That's right.
So I have a question.
All right.
Let me fix my collar.
Okay.
Caller as well.
Now you have mentioned about how you these credit card agencies, they offer you 18%, 18 months with zero interest. Like, do they get that money back after those 18 months, like somewhere?
Listen, they know that most people will still carry a balance. Okay, now, but just to make sure, if you notice, they're going to charge you, most of the time they'll charge you 4%. So let's just say you have 10,000 somewhere, and they say, hey, you can move that over here and you won't have to pay interest for 18 months. So, but they're going to charge you 4% up front just to cover their costs, right? And they know that in 18 months you still have a balance, and then all of a sudden, boom, you're back to 28%. You know? Now, I mean, it's in some cases it makes sense. You know, if you know you got some money coming in or whatever, so in some cases it makes sense. But listen, banks don't, you know. You know why the government takes their taxes from our paycheck? Because they know if they didn't take it, we wouldn't pay it.
Yeah. Pretty much.
Yeah.
You know, I mean, I'm self-employed. So, you know, when they get my taxes on the 15th, why am I going to send them money early? Now, you got estimated tax and all that. Wait, you know what? I don't want to get anybody in trouble. You know, pay your tax. I understand. You know what I'm saying? But, you know, everybody gets excited about getting a tax refund. And I understand that. But if you got a tax refund, all that means is that you pay too much. It's a refund. They didn't give you anything. They just say, hey, you gave us too much here. And they give it back to you with no interest. You know what I'm saying? So if every year you're getting like $5,000 in your tax refund, why don't you just invest like $500 a month? And then at the end of the year, you get nothing, but you got $6,000 in your,
Wow.
in your 401k or in your IRA.
Mm-hmm. Oh, and we're gonna have to have a conversation after this. Okay, we have more questions coming in, and let me know when if you want to go through all the questions tonight, or
we're already over an hour. I'm gonna have to charge you time and a half.
Fine.
I'm only kidding.
You do owe me lunch. Remember that. You and a fee, so okay. There you go.
Oh, that's right. We owe you. That's right. Go ahead.
Well, this is from Angela by way of Covina. So if we have a 401k and need to borrow, what should we do? Rely on our emergency fund or take out a bank loan or save more?
Well, save more, You know, but I'm saying the 401k should be a last resort. Okay, that's why you should have because listen, if you have an emergency fund, chances are you're not going to need to borrow from your 401k. You know what I'm saying? But it's just we just have this. A lot of it just borrow it because we can. You know, there's so many people that borrow from their 401k, and it wasn't really, you know, I have people that borrow from their 401k because the debt got out of control, and I understand that. But remember, if you lose that job or something, then that doesn't become a loan anymore. So I would do it as a last resort and pay it back as quickly as possible. But it's you know, work on that emergency fund, you know.
Okay. And here we have another question. Okay, you're busy tonight.
Oh, okay. So this is from Angela Holmes. If we have a 401k and oh, I'm sorry. It's the same type of question.
Okay, sorry.
Yeah.
All right, here we go.
Okay, go ahead, Senior. What would be a good dollar amount to consider having when retiring if you're retired at 67?
Well, that all depends on how old you are, right? If you're 60, right? If you're 30, you're gonna need more money than somebody who's 60 because there's a little thing there called inflation, right? So this is the way inflation works. Your first brand new car will cost you about what your grandmother paid for her house. Okay, it's inflation. Okay, when I bought my first house in Willingboro, New Jersey, I paid $68,000. My granddaughter in a couple of years will be buying a new car. What do you think she's going to pay for a new car if it's a nice one, right? She's going to pay about that, right? So when I bought my first car, it was a 1988 Volkswagen Jetta. I think I paid about $18,000 for it. And that's how much my grandmother paid for her house. So the younger you are, the more money. So now, listen, retirement historically what we call a three-legged stool, right? A stool has three legs, right? One is Social Security, one is a pension, and the other one is what you saved, right? That's a three-legged stool. We know now that pensions are something that's gone away, right? There's not too many people have pensions. So now you got people on a two-legged stool. They're rocking now because now they don't have a pension. So now you're waggling back and forth. You lost your stability, right? So in most cases it's going to be right. So, but you might have a 401k. So your three-legged stool might be Social Security, if you think it'll be around. 2 will be your 401k, and then 3, what you're saving on your own, right? So what happens is this. So now I have people right now in their 60s looking at retiring. So I say, okay, how much do you think you're going to need monthly to maintain your current lifestyle, right? So they say, okay, I think I'm going to need $7,000 a month. Okay, let's go on the Social Security website and see how much you're getting from Social Security. So let's say they're getting $2,500. Okay, $2,500, right? We got $4,500 to go. You got a pension? Oh yeah, I got a pension at work. Call H&R, ask them how much is your pension if you take it at age 67. Oh, they got back to me. It's $2,500. Okay, so you got $2,500 from Social Security, right? You got $2,500 from your pension. That's $5,000. Where's the rest of the money coming from? If it's not coming from anywhere else, then you need to readjust your budget, or maybe you need to retire a few years later. Now, they might have a 401k. Okay, cool. How much you have in the 401k? Oh, I got 300,000 in the 401k. Okay. 300,000, you know, that'll you can annuitize that, and that'll guarantee you maybe like $1,500 a month. So you're there. Now let's say your 401k maybe is only 100,000. I says, well, then that means, you know, you're gonna run out of money. So one of the things that I'm experiencing is when you first retire is when you're gonna spend the most, because you're hitting right now I'm hitting all my bucket list stuff. Right? I go to Puerto Rico twice a year now. I do this, I do that, blah blah blah. You know, you have money that you can spoil your grandkids. My right. So like, because when I was young, I was broke. When I was young and we went to McDonald's, we didn't go inside. We went to the drive-through window and I ordered because I knew how much money I had. Right. So I ordered the kids' food and I just ordered a drink for me, because I knew they weren't going to eat everything. So I just drank my soda, and whatever they left, that's what I ate. Okay. Now, as a grandfather, we go inside. And I take my grandkids inside and I say, I got to go to the bathroom, pick whatever you want. Okay. So in your early years of retirement, you're going to spend more. But then, you know what I'm saying? 5 years from now, you know, you slow down a little bit. Okay. The key to a good retirement is stay out of debt and stay healthy, because bad health will really, you know, in addition to the physical stuff, financially, it could really hurt you. You know, but you try to prepare and be as good steward as much as possible. Remember what we started with. There's certain things you can control, and there's certain things you can't control. I can't control my health, but I can control my debt.
That's good, Ed. Okay. Kuvina says, we thank you. All right, here's another question.
Okay, this is from Brandon Sheard, right? That's your nephew.
Cute nephew, yes.
I saw him. Okay, let me focus. All right. Any other useful money tips, like living on 80%? Just doubled my income and want to be wise with new money.
Double? He's taking me on vacation. You didn't double it.
Well, tip number one would be take your aunt on a nice vacation, and okay, but listen, I don't know specifics, but if you don't have a Roth IRA, I strongly suggest you get a Roth IRA. Now remember, and we'll get to this in the future, when it comes to investing, there's two decisions you got to make. One is, what kind of account are you going to have it in? Is it going to be a traditional IRA? Is it going to be a Roth IRA? Is it going to be a TOD, which is a transfer on death account? Is it going to be an UTMA, you know, uniform to minors? You might want to open an account for a child. You might want to do a 529 that specifically. So there's a lot of different accounts. So the based on what you want to do, decision number one is, what account do I want to open? And it might be multiple ones. Decision number two is, what kind of portfolio am I going to have in that account? Because the portfolio, remember the buckets? Those three buckets that I talk about, guess what? Those three buckets, if you were going to put money, it's three different portfolios. You don't invest the same way, right? So the money that goes in bucket one and the money that goes in bucket three are you know, they're totally different portfolios, because one is short term, one is midterm, and then one is long term. So you gotta invest accordingly. The shorter term you have, the more conservative investor you should be. See, when I was 20 years old, right, I loved the roller coasters. Woo! Right? So when you're 20 years old, You don't mind the stock market like this. But now I gotta, you know, I'm like this. I take the rides that go like this.
Yes.
So this is the kind of investment you should be. It still goes up and down, but not like when you were 20 years old. When you're 20 years old, the market could be up 30, it could be down 30. It don't matter. Just stay in long term and you'll be okay. So for young persons, the longer you stay in the market, the less chance you have of losing money. Because it's time. It's not timing in the market, it's time in. Everybody's trying to time the market. Most of the time you lose. But if the longer you stay, that means the ups and downs, all right? Because this is one thing I could promise you about the stock market, that it's gonna go up and it's gonna go down. And you have to know what impact does, right? A lot of people get upset when the stock market goes down. But if you go into Macy's and you see 60% off, you get excited. Wow, there's a sale, right? So when the market drops 30%, everybody's saying, I got to get out. And the wise people are saying, yo, there's a sale going on. So when everybody else is selling, they're buying.
Okay.
Dropping jewels. Yes.
You're making this old guy work too hard.
Oh, you can handle it. You can handle it. Wow. Okay.
So the younger you are, you have time on your side. The more aggressive you should be. If you're middle age, you want to be like what we call a middle. Okay. Mm-hmm. So having a four-legged stool would be a luxury. Yes. If you have a pension and a 401k and Social Security and your own IRA, that means if one of the stools break, you won't fall.
Yeah. Awesome.
Yes.
Okay. See.
That's right. Okay, so we have Mr. Marcus 520 again. What are the prerequisites to becoming an investor broker and a mortgage broker?
Well, one you gotta find a company that'll sponsor you. If you know somebody that's interested, they can give me a call. Two is you have to have a clean background record. You know, unfortunately, if you have a felony, chances are the state. This is a industry rule, right? Because remember, in the area of life insurance, each state has their own agency. So, for example, if I'm licensed in New York, I'm governed by the state of New York Department of Financial Services. Investments is different. Investments is national. It's overseen by the federal government. Okay, mortgages used to be governed by the different states, but because of the mortgage debacle, the federal government took over. So now mortgage brokers are federally overseen. You know, so but you have to take a class, you have to pay a test, you have to take a test, pass the test, and you have to do it through somebody who will sponsor you to get in. But they will do a background check, fingerprints, the work. So if you know somebody, they can forward your info to Shirley, and I could give you some specific on that.
What? Okay.
Just like I started. I mean, I started this, you know, when I said, you know what, I don't want to work for anybody else no more. I did that, done that, it didn't work out. You know, if I'm gonna fail, I'd rather fail on my own and not like, you know, do a good job. And then the company went out. So I've been on my own for a little bit now. Okay. But the good news is most of the tests are multiple choice, no math. That's what got me in. When they told me the test was multiple choice, no math, I said, okay, I'm in. Now on the investment license, you get a few math questions, and on the mortgage, but not too many. So you don't have to be a math wizard. And they give you the answers. You just got to pick the right one.
Okay. Okay.
Because I just have my PhD. Shirley, you know what the PhD is, right? I got my PhD from Julia Richmond, public high school diploma.
All right.
I love it.
We got Brandon who says, thank you. Thank you. Very informative. I'll put it to use after taking my aunt on a vacation.
Yes, I'm ready. I'm ready.
I can read the ha-ha part.
You have a little sweet nephew. Okay, let's see. Another question.
Okay, we got Heron again. Explain how the existence of annuities work, especially in today's market. Do annuities still exist?
Yes, the annuities still exist. There's been a lot of changes in annuities the last couple of years. Okay, one of the not getting so specific, but basically, an annuity is actually an investment, but it's an insurance product. So it's almost like having insurance on your investment. Okay, historically, they had gotten a black eye because their fees were very high. But in some cases, they still make sense, and the fee structure has changed a lot. I mean, I have some clients that are in annuities with no fees. So and obviously, I checked it before I said, wait a second, no fees. But yes, no, but there's different. Not normally what happens is some people, if they have like when you hit the lottery, they say, do you want a lump sum or do you want monthly payments? Well, some people, when they retire, they have a lump sum and they're afraid they're going to spend it too fast. So they'll put it in an annuity and the annuity company sends them a monthly check. So at least they know they won't run out of money. But they still exist, but the whole landscape has changed. There's probably about 7 or 8 different. There's some that I recommend and there's some that I don't, but everything it depends on the individuals. But I do some stuff with AXA. I do some stuff with Bright House, Lincoln Financial also, but they all specialize in different things. So depending on my clients, some of them use one company because they all have their uniqueness to that. A lot of 401ks are in annuities. But if somebody has something specific, or I could even in the future, I could have one of the annuity guys come and maybe do a 15-minute class on annuities. I can have Bright House or Equitable come and do a little presentation for you guys. We could probably, because as you get older, that's something that people consider. If that's something that, basically, if there's something that you want a little bit more emphasis on, let Shirley know and we'll try to get that in.
Okay.
This is from Angela Holmes. Great information. Have me thinking about a Roth account now. All right. Great job. All right.
Okay.
Yes.
Call Afia. She just got her securities license. She can open one up for you.
And there's her information right there. Okay.
Awesome. Perfect timing.
Okay, so this is going to be in the chat so everybody can see your information, how to contact either one of you. And I thought that was the last question, but we have one more. So we're going to take this one question. Okay, there we go.
Okay, yeah, good question. Okay, so the maximum contribution.
Okay, this is from the Cola. Oh,
she was frozen.
The maximum contribution. It depends on your age. I think it's either 7,000 or 7,500. Okay, and you have until April 15 to make a contribution to last year. So you can still make a contribution to your 2023 IRA as long as you do it before April 15th. You have that. So I have some clients that they do monthly and they'll call me. Hey, listen, how much did I put in? How much more can I put in? I have one client in April. She always gives me her IRA because she wants to take it off her taxes because she has a traditional one. Now you don't get a deduction on a Roth. But if you have a traditional, but they both have capsids. So the short answer to that is it depends on your age. You could Google it, but you do have until before April 15th to do your 2023 contribution.
Okay. I think that is the last question for this evening.
Can I?
Yes, she's freezing. Okay, hold on.
Shirley, thank you for letting us share. I hope that it brings
in the subject line
knowledge to people,
it-
and you know, I think it's information that people need to know. We need to become better stewards.
Yes.
You know, it's amazing how in the Bible it talks more about money than the rapture. I think God knew we were going to have problems with it. You know, so but this is not about, you know, prosperity or wealth building. Is about just, you know, managing your money correctly, you know, so you can help yourselves and help whatever ministries you support, your children. So it's important that we become, because you know what, bad people do bad things with money and good people do good things, you know. So it's important for us, you know, as believers to become better managers of our money.
Yes, awesome presentation. Effie, you had something, but you kind of froze, so I didn't get all of what you were saying.
Oh, shoot. You want to put it? Shirley, can you hear me?
Yes.
My Yahoo account is MZAFIA. Not the R. The R needs to be removed.
Okay.
And is it okay if when if they do email us that in the subject line, if they could put what is it, TIHMO, so we'll know that it's coming from your platform? Is that okay for people to do?
Yes, that is fine. Yes, and I will change.
They could just send me a text and say, "Listen, I was on the Hope Outreach Ministry, and if they have something specific they want to talk about, that's fine also." And then you know. So you know whatever you feel in the future would help. You know, let Shirley know, and then we'll come back and address something more specific. Appreciate your time.
Yes, thank you both so much for this evening. And I don't know when the next time we'll come on again. We'll discuss that to see when the next session is, because it's definitely be more than one session. So this was so much information tonight. Great information. And I know we had so many great questions. And I'm pretty sure there'll be more in the comments. So I'll be watching the comments and I'll bring any new questions that may hit the chat for our next session, whenever that shall be. I really appreciate you both so much. I mean, Ed, you did an awesome job in your presentation. You covered so much in an hour and a half, and you answered everybody's questions so well. And I feel you read them so well. Everyone, you both were great. And I'm very honored to have you on this platform.
Oh,
I really am. It's great information. So everyone, thank you for joining us on tonight. Make sure if there's certain topics that you want Ed to discuss, that you please put them in the chat, or you can messenger me, or you have the information on the screen. You can also messenger them or text them. We want to be able to cover topics that you have questions about. Also, we want you to please share this live. Share the YouTube link and also share the Facebook link. We want to get this information out to everyone that needs help with managing their money. I mean, I've learned so much tonight, and I have like notes on both sides. So I learned a lot, and I know I'm going to have more questions, but I don't want to hold this up any longer. It's been an hour and a half, but it's been awesome. Thank you so much.
This was amazing. Thank you.
It was. I had such a good time with both of you. Okay, hold on. All right, people are saying it was excellent. People really enjoyed it and learned so much. So you'll see all the comments after this live. We have a lot of comments. We had a good showing tonight. Many did not comment, but we had a very good showing tonight on both platforms. So you guys did great.
Okay.
You did great. So thank you again. And anything else anymore? Let's see. Okay, hold on. Okay, yes, that's it. So thank you again. And like I want you two to stay on when I end the live, you two stay on with me. Afia, you had another question? Afia?
No, I'm just trying to figure things out because everything's freezing.
Oh. Okay, well, I want to thank everybody again for coming on tonight, and we are going to be signing off. And as I always say, I love you all, but God loves you best. I pray that you all have a blessed evening, and we will see you in our next session. Stay tuned. Watch our Facebook pages, watch our YouTube channel, as well as Afia's channel. Facebook page, as well as. Are you on Facebook, Mr. Ed?
Yes.
Ed Sanchez, you are. Okay, watch all of our Facebook pages. We are going to be blasting.
They'll just see pictures of my grandkids on the Facebook page.
Okay. But we thank you all so much for joining us on tonight. Everyone have a blessed night. Have a blessed, safe weekend. God bless you all. We love you. All right. Good night, everybody.
God bless.
Good night.